Hey guys, Nicole here with Momentum Accounting. In this video, I'm going to be going over how to explain and calculate the return on investment for marketing. So one thing I see accountants do a lot when they're going through the profit and loss statement with their client and their client asks, how can I be more profitable? One area where accountants like to go to right away is say, well, you're spending a lot of money in marketing. Maybe you should cut your marketing expenses. And think about marketing is not actually an expense. It's an investment in future revenue. So we can't think of it the same way as we think about other expenses on our profit and loss statement. In some cases, better advice might be that you need to invest more in marketing. Maybe you're making, for every dollar you spend in marketing, you can make $10. Wouldn't you want to put more into marketing? And so we can't just give blanket advice and you need to cut marketing expenses. What you need to do instead is be able to explain to them what their return on investment is. If they spend $1 in marketing, how much money do they actually get back? So this is my marketing ROI calculator. So first I'm just going to start by, what we want to do is we want to take on a monthly basis all of our marketing costs. And so you can see we've got our fully burdened labor costs. Maybe we've got an in-house marketing staff or a part-time marketing person. And when I say fully burdened labor costs, that means what's their payroll, their gross wages plus their payroll taxes plus any benefits. And this could also be like a marketing contractor, right? So maybe you're paying a marketing contractor $3,000 a month. Then we want to know, what are our salespeople costs if you have a salesperson on staff? And then we want to know if you have contractors, if you're spending money on advertisement, marketing campaigns, travel costs, non-marketing staff costs. So this actually pulled in, sorry, this isn't. So that would be all things that you could pull from your P&L. And then the non-marketing staff costs. This is a big one I see where we have, in some case, a lot of small businesses, the owner is actually doing the sales. So we need to consider the owner's salary in terms of marketing costs, allocate some of that. And then same with I've had clients who they have delivery staff, right? I have a client that's does HR services, and every month they do a webinar. And so they have a couple people on their team that do the webinar, and these are client-facing people. And the client-facing people are spending time getting ready for the webinar, presenting it, coming up with the content, all of that. And so really, while their costs are showing up in their direct expenses on the profit and loss statement, that's actually marketing dollars that the client is spending on those people. And so we need to do an allocation. We don't necessarily do an allocation on the profit and loss statement if it's an insignificant portion, but we do need to be aware of it, and we do need to consider it in our marketing costs. So you can see here, I've calculated that are between the owner's salary and maybe another staff member who's doing some of these webinars, that it's costing $2,600 in time in terms of the internal staff. So, and what I'm doing here is I'm just estimating how many hours that each person is spending and then what their hourly cost is. Okay, so in this case, we're saying this company is spending let's just get to the modern day here, is spending $7,000 per month in marketing dollars. Okay, so the question is spending $7,000 a month a good investment? Is that getting them a return? So we understand the marketing costs. The next thing we need to know is, what is the lifetime value of a customer? So if we come over here to the LTV calculation, LTV is lifetime value. We want to know, hey, once we get a client, what's the dollar value of that client? So in this case, the way that's calculated is we're assuming that this client, for the value of one client is $3,000 a month. So maybe they have some clients that pay $10,000 a month. Maybe sometimes they have clients that pay $1,000, but the average ends up being $3,000 a month. And the easy way to get to that is just take your total revenue divided by number of clients. Easy, right? And then then we have to multiply that by, so we've got the revenue, but then straight off the bat, usually about half, 50% of that is spent on our delivery team. So our staff that's delivering that services. So on your profit and loss statement, that would be your direct cost as a percentage of revenue, which if you go back to our 50/30/20 rule, we want that to be no more than 50%. So on this case, I'm just going to assume it's 50%. So that means that one customer per month, after we're paying our staff to deliver the services, is worth $1,500. Then we're going to take the average amount of time that customers stay with us. So in this case, we're assuming that a customer stays with us for 3 years. And so the lifetime value of that customer is $54,000. Now I have another worksheet here. If you have a client or if the business model is not necessarily recurring, it's more like one-time purchases, then you can use this tab over here on the right. Okay, so once we know the lifetime value of a customer, we need to understand the customer acquisition cost. How much does it cost us to acquire that one customer that is worth $54,000? So on our CAT calculation tab here, you can see I've taken that $7,000 that we calculated on the first tab, the marketing cost. So and realistically, that $7,000 isn't going to be $7,000 up every month. It's going to change. So, but in this case, let's assume it's $7,000 every month, and then we're going to count how many, go back and put how many clients we acquired each month. Okay, so we know, in a month where we acquired 2 clients, it was. It cost us $7,000. We got 2, so the customer acquisition cost per client is $3,500. Okay, so now that we know our lifetime value and we know our customer acquisition cost, then we can go to our calculation over here. So in this case, I just assume that the customer acquisition cost, or I'm going by quarter here. So the most recent customer acquisition cost, you can use an average, you can use, you can look at the last month, whatever time period you want to look at. So in this case, client is worth $54,000. The cost to acquire them is $7,000. So that means that our ROI ratio is simply our 54,000 divided by 7,120. And so what does 8 mean? What is the ROI ratio? So down here we have a key. So the higher that number, the better. And so if it's less than 3, it indicates you're not getting an ROI in marketing spend. So that's a situation where you might tell a client, hey, your marketing sucks. It's not working. Maybe you cut those costs, or you think about using a different strategy. And then 3 to 1 or better is good. 4 to 1 is great. 5 to 1 indicates you could be underinvesting. So in this case, you might tell this business owner, hey, you should pump more, and whatever you're doing, do more of it, because you're getting a great return on your marketing. So that's how to use the calculator. Hopefully you found this useful, and I'll see you at the next video.